Welcome back on the second topic, which is the bad pattern, second topic of the advanced pattern. And I believe that you guys are not overwhelmed with all the information that you are getting because at some stage you'll get to understand it much more better and accurately. So I want you guys to just focus on what you can take in as much as possible, and then all you can do is practice what it is that you have learned from this lesson, just so you'd be able to just move forward with all the knowledge that you have. So just by taking a look at it, what we are going to be covering is the tools that you need, obviously. We are also going to be covering the types of patterns, the bad patterns, how to identify the bad pattern, and how to place stops and target on the bad pattern. So the tools that you need, obviously you do need the Fibonacci retracement. You need the triangle tool, on which I'll show you guys on the TradingView platform, and also the long shot tool, which is there to guide us with the risk compared to the rewards. And these are the two types of patterns. There's a bullish bet, there's a bullish bet, and there's a bearish bet. So a bullish bet would look something similar to this, whereby obviously it's a bad pattern, advanced pattern that will give us a signal to the upside, and a bearish pattern, obviously it's the same but vice versa, that gives us a signal to the downside. Okay, so in the bullish market, I want you guys to be able to spot that obviously the reason it will be a bullish bad pattern is because of that we are looking for buy opportunities. So obviously in here we have to have higher highs and higher lows in order for us to be able to see that we are really in a bullish pattern. And in order for you to start utilizing this, obviously you have to take your points from, let's say, higher low to higher high. That's how you actually put the Fibonacci retracement. Instead of doing it vice versa, your 100% should be at the bottom, which is the higher low, and at the highest should be your 0 percentages, and then in the middle that is a retracement. That is for the bullish market. And in the bearish market it's vice versa, on which you have lower highs and lower lows. So obviously utilizing the Fibonacci retracement, you take your 100%, it's at the lower high, then the 0% is actually at the lower low. As you can see here, I've got this perfect indication to just show you guys, just so you'd be able to understand. And the price that's going to be coming in between the 100% and the 0 percentages is actually a retracement. It's where it is retraced. So let's say if you can see the first retracement here, after the lower low, you can simply see price went up to 78.6 percentages. So that's how you actually take a look at these. Looking on how to identify bullish bad patterns. Firstly, you start by taking the impulse leg X to A, and then take the Fibonacci retracement from X to A. The retracement should pass 50% but not close at 61.8 percentages, which is simple. I don't want you to be confusing this, because basically if you just take a look at the right picture, the picture on the right side, you take the Fibonacci, there's an impulsive leg, obviously it's a bullish market, from X to A. That's an impulsive leg, X to A, all the way to the upside. Meaning that now you take the Fibonacci retracement, you started from X up until A. That means X is going to be where 100 percentages is, and A is actually going to be where the 0% is. And the retracement, this which is B now, but I will speak about it on the next point, but the retracement should pass 50% but should not close at 61.8 percentages. Now I'll show you guys real examples too. We now have the B leg. So as long as you see the retracement passing the 50% mark but not closing below 61.8, that is the B point. That's a B leg. So now you take the Fibonacci retracement from A up until B. So now A is actually going to be 100% and B is actually going to be your 0 percentages. And then point C should touch 38.2 but not go past 88.6, meaning that the point at C should go past 38.2 percentages but should not go past 88.6 percentages, which is how you get accurate bad patterns. Now you have the C leg. And then for D it is your entry, obviously. For D, what you do is that you take the Fibonacci retracement from X to A, and then D point is found on the 88.6. Do you see how different it is compared to the Gartley pattern? The D point is actually found on the 88.6, because once you do take the X from X to A, you'll be able to see that, okay, B is actually going to be between 50 and 61.8, and then now the D is actually going to be 88.6, which is your entry. That's what you're going to execute. Okay, how to identify a bearish bad pattern, which is the same but vice versa compared to the other one. Start with the leg X to A. Take Fibonacci retracement from X up until A, and then the retracement should pass 50% but should not close at 61.8. Obviously you start with the X to A. It's a bearish market, meaning that the impulsive move is to the downside. you take X up until A, you basically, X is going to be your 100%, A is going to be your 0 percentages, and then the B leg should go past 50%, but should not go past 61.8. We now have the B leg, and then take the Fibonacci retracement from A to B. So basically what happens is that when you take it from A to B, it's your A leg is going to be your 100%, and then your B leg is going to be your 0 percentages, and the point C should touch 38.2 but should not go past 88.6, meaning that point C should be any could be any retracement that's between 38.2 and 88.6, even if it's 61, even if it's 50, even if it's 45 or something like that, any point, as long as it's between 38.2 and 88.6. For D, obviously you take the retracement from X to A, and then point D is found on the 88.6, which is the entry. Your D point is our entry. Okay, so here's a quick example on how to place stops and targets on the bullish bed pattern. For target, take the Fibonacci retracement from A up until D, and 50% is target. So basically, to get your target on a bullish bed pattern, you take your Fibonacci retracement. You start off from the A leg up until the D, which is your entry. And you start from the A up until your D, which is the entry, and then the 50 percentages, which is in the middle, is where your target is going to be. Okay? And then obviously for stops, you place stop loss 5 pips below level X, which is the starting point. Your stop loss should be 5 pips just below the starting point, which is your X. Okay. Same thing vice versa with the bearish bed pattern. For targets, take the Fibonacci retracement from A to D, from A up until D, meaning that A is going to be your 100%, D is going to be your 0 percentages, and then 50% of that is actually where you're going to be putting targets. And for stops, you place stop loss 5 pips above level X, which is where you're going to be able to just secure as much profits as possible. And you can see that we get activated by wicks utilizing these advanced patterns. And now we're going to be taking a look at the best way to get high probability advanced pattern. There are two types of scenarios you can find these patterns: continuation and continuation advanced patterns, and reversal advanced patterns. Always look for bullish bed patterns in an uptrend, which is continuation, and always look for a bearish bed pattern in a downtrend, which is a continuation. Meaning that when you're in an uptrend and then you are looking for a bullish bed pattern, there's a higher chance of that being accurate because you are not. It's just a continuation to continue going to the upside, and vice versa. If you are in a downwards trend and you get a bearish bed pattern, it means that it's just a continuation. It's a confirmation of a continuation going to the downside. And you can as well look for bullish bed patterns in a bigger time frame support level, which is a reversal, meaning that if you're on the daily support and then on the 1 hour, let's say you find a bullish bed pattern, obviously it means that there's a higher chance of us reversing from that area and then going back to the upside. The same thing with the bearish bed pattern. You can as well look for bearish bed pattern in a bigger time frame resistance level. And that's actually a reversal, meaning that when you're at the resistance of maybe a 4 hour or daily and you get a bearish bed pattern on that resistance level, that could as well be a reversal, meaning that price is now ready to go back to the downside. Okay, I believe that we can make an example from Euro GBP, on which it's one of the bed patterns that I spotted. And I think that we can just give this as an example so you'd be able to see how to utilize these bed patterns. So for instance, we say that you start by X and A. So I spotted my X leg, which is, this is the X, and the A is all the way up to here, which is my impulsive leg. Obviously, I'll just take it from here all the way to the upside here by A. Super simple. And we're saying that the second step is you have to look for the B leg, on which the B leg is the 50%. It should touch the 50%, but shouldn't touch the 61.8. And you can see price went down here. We did touch the 50%. And even if it does play between here, it's also okay to play between it. Like if price just comes, retraces here and then go back to the upside, that's still okay, as long as it doesn't close below the 61.8. That's one thing that we're trying to avoid, it closing below the 61.8. So this is a valid B leg. So let me just do this to show. Okay, X, then we've got B, A is here, which is our A. Okay, and then let us look for, okay, we've got the B leg, which is here. The B leg, we found our B leg. The B leg. Okay, let me remove this. Here's our B leg. And then after we found our beautiful B leg, one thing that we the next step is actually us looking for a C leg, and the C leg we say that you have to take price from the A leg, up until the B leg. So you can simply see that now we've got price should be anywhere between 38.2 and also 88.6. And you can see there's a perfect one. It went up to 61.8, which is clean. It should be anywhere between this. Then it's much more safer for us to be looking for this. So now we've got our C leg. Okay, our C leg. Let me put this as C. There we go. And I can just remove this real quick. Okay. So now we've got our C leg. It's X, A, B, C. And then now for the D leg. So what happens is that normally someone would be asking me, how do I then take this as a trade? Obviously with the market, let me just do this real quick. The market is going to be, let's say here. The market is going to be somewhere here. Now you've got your X, you've got your A, you've got your B, you've got your C. So what happens is that to get the D leg from the, like using the bad pattern, you obviously take this from all the way down to here, up until all the way up to here. And then the 88.6 is where your entry is going to be, is where your D leg is actually going to be. Let's do this. D leg, D, which is your entry. Okay, this is where the D leg is going to be. So what you do is that you would have your entries right here, your buy limits right here. Okay, your buy limit right here. And then your stop loss, you said 5 pips below. So as you can see, it's saying X here, X is actually 12 pips. So 5 pips below would be something like a 17 pip move, 17 pip move, 17 pip move. And obviously, if this is the D leg, if this here at the 88.6 is the D leg right here, if this is the D leg, obviously you can now remove this. You've got your point. One thing that you can do to measure your targets just to see if your risk to reward is amazing, bring this over to D, which is here. From A up until D is where you get your target, which is the 50% right here. Okay, and you can see it's giving us a risk to reward of 1:3, which is amazing. So obviously now you have your buy limit, you have your stop loss, you have your target, and then you can just see how the market is gonna move. Let's see if it's gonna activate us. Okay, let me even draw this real quick, just to indicate that this is a real bad pattern. This is how we are going to be having this within the markets right here. Okay, then let me just even remove this, because you can see it's already at the 50 level, so it's target. So let me remove this so we don't have a lot. It's very, when even utilizing advanced pattern, don't have a lot of things on your charts. Like just have the bad pattern, also the short or long too, because if you have the Fibonacci's and so on, it's gonna look messed up, it's gonna look messy. Okay, so you can see price is still moving a bit. You still have your entry here, price is moving. So let us see when is it going to activate us. Okay, price is playing around just a bit. There we go. So basically you can see what happened here. We got activated here. So you have your buy limit, and now you are in this trade. You got activated by a week, and then price is now playing around. Okay, you have targets and so on. So you can decide whether to move at break even. You can decide to I don't know how you'd be managing it, but this now we are close to approaching targets. As you can see, you can lock as much maximum profits as possible. You can lock 1% and so on. So here we did hit targets. Right, as you can see, we hit 3% on this beautiful trade. We got activated by a nice week here. So and there's a lot of setups that are gonna be like this. I noticed with especially with the bad patterns, I get activated so many times with only weak entries, and as much as they are risky, they are also so like advanced patterns. So you need to take time in order to understand on how this works. You need to practice as much as possible, just so you'd be able to see if this is really working out for you. And that was amazing. We just hit target on this one here, the bullish bad pattern. So let us take a quick example at the bearish bad pattern. So the same thing I spotted actually right here. So I'll just take price from here all the way down to here. Okay, so I'll say, okay, let me just remove this. Okay, I can decide to either remove it or leave it, but let me just remove it so you don't get confused. Okay, let me remove this. Okay, let me leave this out. So this is my X leg, this is now my A leg. So we are done with that bad pattern. I mean the bullish bad pattern. We are now looking at the bearish bad pattern. So don't confuse the two. We are now at X, and this is my A leg. Okay, sorry about that. Okay, this is my A leg. I wanted to remove this here. There we go. This is now my A leg, and then now we are looking for B. Okay, X, A, I'm sorted. We are now looking for B. B, we said that should be anywhere between 50 and shouldn't close above 61.8. Nice, it didn't close above 61.8, which is super clean. We've got our B leg right here. Here's our B leg. Okay, and then we said that taking A to B, we should be looking at. Okay, let me remove this so you don't get confused. You don't see a lot of lines. It should be any number between 38.2 and also 88.6. So you can see it went all the way up to 61.8, which is safe for us to find a C point right here. And then the very last one, which is the D leg, our entry, we have to take a look at the X2A, and then 88.6 is actually going to be our entry, D leg, ne? D leg, entry. Okay, let me do this. Here's our entry, 88.6. There we go. So what happens is that looking for entry, getting an entry on this, let me just sketch this out real quick. X to A to B, okay, and then B to C, C to D, right here. Super simple. Afterwards, we take A up until B in order to look for targets. A to D, I mean A to D, there we see. So what we're going to have here is actually a move such as this. Our X leg is right here, so it's 8.9 pips. We said at least 5 pips above, so it should be, okay, it's, let me say 9, 10, 11, 14 pips basically, 14. There we go, exact 14 pips. So this is a nice, it's actually a nice opportunity to be trading this if you are day trading it, and then target is obviously 50 percentages, which is here 50 percentages. And normally I'll prefer this one here being risk reward of 1:2 above, which is very safe because there's a high chance of us hitting targets. So you can simply see 2.3, which is amazing. So let me just remove this so we take a look at how it plays out. As you can see right here, we would have, okay, while moving all the way to the upwards, right here would have been activated by just this beautiful wick right here. And then let us see, going to the downside, if we are going to hit targets. Okay, let's see, not yet, we didn't hit targets yet. Price is playing somewhere close to targets. So here you can decide to either log maximum profits right here, or to just take, okay, I wouldn't say take profits, but to just manage it in a specific way, because, you know, we are already advanced within this field. So you already have the management tools. As you can see, now we hit targets, and then we went all the way below structure. So this is it's showing you guys that so far we made, you know, 3% from that buy move. We made 3% going to the upside, and now we made 3.4 percentages going to the downside, meaning that we made 5.34 percentages from just buying that bad pattern, and then that bullish bad pattern, and selling the bearish bad pattern. And I like the fact that this is actually something that you can spot, and then put your buy limit, your stop loss, your take profit, and then leave whatever that you're busy with. When you come back, you're going to see if it hit profit or if it went against you, and then you learn from it, because there's multiple things that you can learn from, you know, taking losses and also taking wins from this. But that is it, and that is the bad pattern. Let us move on to the next one, which I believe it's we've done the Gartley. This is the bad pattern, the cipher pattern. See you guys on the next lesson.